Greetings, everyone, and welcome to the Royce Report, where we provide detailed information on how to grow and expand your company and how to have your business operate more effectively and efficiently. I'm Todd Smith, and if you have not already done so, please hit subscribe, hit the bell as well, and you'll be notified each and every time a new video is posted. There always comes a time in a business's life cycle where they need to grow and expand and sometimes even get their business started, that they can no longer self-fund. They need to find outside resources. Many businesses struggle and ultimately, unfortunately, fail because of the lack of capital resources. There are three ways to fund your business, and that is with debt, equity, or grants. In this video, we are going to cover 8 different types of debt financing. Now, debt is not a bad word, nor is it inappropriate for a company to take on debt. The key to any type of debt financing is the benefits of the loan payment, the loan repayment in total, far outweigh the cost of the debt. So here are 8 different ways to finance your business. The first is family and friends. Now, this will depend upon the financial wherewithal of both. Many businesses started with a loan from their family members or a friend, and I know many of them. The key here, though, is to make sure, again, that the benefits outweigh the indebtedness. And I would also recommend writing it down so everyone knows the terms of the repayment. The second is a traditional term loan from a lending institution. It's really simple. They loan you X amount of money at a specific interest rate, and you need to pay it back monthly on a set payment plan. Now, for those of you who are watching this video and you need smaller amounts of money, say $20,000, $25,000, $15,000, never discount the benefit of a credit union. A lot of credit unions, that is what they like to loan to, $5,000, $10,000, $15,000. It would be on pretty much a personal loan that you could then use for your business. Then there's government guaranteed and government backed loans, which is number 3. The two that I'm most familiar with are the USDA, the U.S. Department of Agriculture, and the Small Business Administration. These are partially guaranteed. It's not 100% guarantee on these loans. So the lender is protected to ease their underwriting and get more money into the economy. I did a great video about a month ago on the SBA Loan Programs, the 3 that I'm most familiar with, which are the microloan, what we call the 7A, and the SBA 504 loan. These are tremendous loans. Now, on the microloan, again, for those who are looking for smaller amounts of money, they will go as low as $5,000. There's a lot of underwriting involved with all these loans, so they are great programs designed to add liquidity and add capital into the small business owners that would not otherwise have access to the capital. Credit cards. Now, we all use credit cards, and they are both a blessing and a curse. They are a way to fund your business. You can buy raw material credit cards, you can pay your utility expenses, your phone expenses, and the list goes on and on. If you have really great credit, there's usually credit cards that have introductory offers where you can have a 0 interest payment for 6, 12, or 18 months. Again, you've got to be careful of not cranking the balances up so much that it becomes a detriment to your company. Now, you can also take cash advances on this. I'm not recommending it per se, though right now, if that's your only access to capital and you have a means to pay it back, that's not a inappropriate way to go. Just remember that these interest rates do get very expensive, though it is a means to fund your business. Equipment leases is number 5. Instead of going to a bank to get a loan to buy a piece of equipment, the equipment vendor would have a third party fund the piece of equipment. The finance company theoretically owns the equipment and you pay a monthly expense on that. And there's usually a buyout at the end. Number 6 is purchase order financing, which is frequently forgotten about with the business owners. It is short-term financing to buy supplies, purchase supplies for a specific order. Now, the best way to describe purchase order financing is with this example. Let's just say you're a vendor to a school district and they are redoing all their computers, and these computers need to be programmed for that specific school system because there's probably more than likely specific emails and settings that need to be put on each computer. Now, the government does not offer deposits on contracts. They usually pay upon delivery or some form of terms to make sure that the product is delivered correctly. So you would go to a purchase order financer. He'd assist you in financing the acquisition of the computer. Now, you get the computers and you do what you have to do, and then you deliver them to the school district. Purchase order finance, again, is short order financing for raw materials or supplies on a specific contract. Now, factoring, which is number 7, is kind of a gray area on whether it is a debt or not. Factoring, let's define that first. Factoring is when a finance firm purchases your receivable. Now, the reason I included in the debt section, because it could still remain a debt to you. There's 2 types of factoring, that is recourse or non-recourse. Recourse factoring specifically is factoring where you sell your receivable, right? And if that person who owes you the money does not pay, then you are still responsible to reimburse or pay back the finance firm. Now, on a non-recourse financing, that does not happen. The financing firm would then go after the person who owes the money. So that's why I put it in under debt, because if it's a recourse factor, then you still have to pay and reimburse the finance firm. Now, purchase order financing and factoring sometimes work simultaneously. Let's go back to our example with the school system. Now, the purchase order financing will ensure that you can get the computers, and so they have financed the supply. You work your magic, you program your computer, and then you send them to the school district. And then what you would do is you'd bill the school district. Upon that billing, the factoring company would then purchase that invoice. It would pay off the purchase order, furnish you with most of what is owed you. There are some formulas involved with that, and then when they get paid, they would then pay you the rest minus the finance fee. Purchase order financing and factoring working together are a great means to finance specific and deliberate contractors. Now, the last one, which is number 8, is mobilization funding. This is specific to the construction industry. Many construction contracts do not come with deposits or a retainer, some type of fee, what we call to mobilize the construction site. This is very true, again, in government contracts. The contractor is responsible to fund the mobilization. Now, a mobilization funding company handles that for you. They will then fund you the mobilization money, the money you need to get started. Why is this important? When I did government contracts, sometimes we did not get paid for 75 days from the time we started the contract. Let's just say it's starting on June 1. You bill the government at the end of the month or July 1. They take time to review it to make sure what you bill is accurate, and then they submit it to the payable department. Then they pay you, and that could take 15 to 20 additional days. So from the time you start a job till the time you get the first payment, could be 75 days. The mobilization funding comes in and bridges that money so it doesn't strap you on a cash flow basis. That's predominantly what debt financing does in all these areas. It prevents you from having a cash flow problem, and the lack of capitals is one of the major reasons that companies do not make it. So whether it be family and friends, term loans, government-backed financing, credit cards, equipment leases, purchase order financing, factoring, or mobilization funding, be sure to get the right financing that fits your needs. Make sure it's good debt, which means that there will be a benefit to acquiring that debt. If you need assistance, my email's down below. Be well, be safe, be happy, be successful, always prepare to win. Please hit subscribe, hit the bell, and until next time, have an outstanding day.